All right, let's welcome in our market voice then, Rakshit Ranjan of Marcellus Investment Managers. He's joining us right now on the show. Rakshit, good afternoon. Great to have you with us this afternoon. Let's talk a little bit more about, some of the earnings performances, and can't not ask you about Page Industries. I mean, this one had been the darling of investors and ready to pay any price to be a part of the Page Industries growth story. But that same growth story is starting to get questioned a bit. Do you feel that it's time now to sit back and analyze what price you're ready to pay for the stock?
No. I mean, in terms of the fundamental strengths of the stock, we keep analyzing, not just now. It's been last 6 quarters that we've tried to understand what's happening at a ground level. So to begin with, I mean, we are still holders. We do agree yesterday's results were below our expectations. But when it comes to breaking the results down into 2 components, one is obviously revenue growth, which was 7-8%. Volume growth was flat, -2, I think. And the second component is margins, which was actually the main reason for disappointment. So on the former front, which is top line volumes, revenue, we are obviously not happy with the absolute number of 7-8% revenue growth in our portfolio companies. We expect on average it to be much higher. But at the same time, we don't see any evidence of market share loss, especially given that bulk of the listed competitors universe is reporting similar or weaker, and more importantly, incrementally weaker revenue growth momentum. But more importantly, the quality in terms of working capital of this revenue has actually improved. So working capital has improved. Inventory days are down. Even dealers, the resentment, the distributors, dealers, the kind of disappointment that we used to see when we would do channel checks 1 year ago, with a couple of new entrants and very aggressive competitors coming in and offering attractive sort of terms to these channel partners. We've seen that resentment go away. So we believe that at this point, in terms of volume revenue, it's more a macro story, less a concern that someone should have on market share. The bigger disappointment, as I said, is on margins. But there, our view is that the kind of reasons that the management has given would suggest that the margin element is more of a one-off in terms of the sort of types of expenses getting bunched up in this quarter, or some of the incentives for the channel getting bunched up, some investments, etc. So we will wait out for 1 or 2 more quarters to see the margin recovery. But on the revenue front, we are quite all right, quite comfortable. The moats are still intact. And this firm, I think, over a longer term, continue to believe will be a true consistent compounders as we expect it to be.
Talking about moats, we were talking a whole lot about, I don't know if you track the stock or no, but since you mentioned moat, bring in IRCTC. That as a company has given you stellar results. Now, whether that's a function of, the fees getting reincorporated in this December quarter, and whether or not the next few quarters as a result of that will also show you an improvement. But this is definitely a business, a monopoly business, and therefore should one look at this as an incremental purchase?
Possibly, yes. I mean, the kind of description that you gave, but we don't have it in our coverage universe yet, because we don't have a sort of couple of decades or 10-15 years of consistent historical track record available from this firm, where the return on capital is far higher than cost of capital, and revenue growth is pretty healthy, and where we've done the work to understand why the history was so beautiful, because that's really the sort of 2 or 3 ingredients that go into our stock picking. To begin with, we need history to be there in a consistent and a healthy manner, but more importantly, we need to have understood that beauty which led to the history, and whether that beauty or the DNA, whatever you call it, whether that is still intact to deliver a very good outcome into the foreseeable future as well. So since that element of work hasn't yet gone in, we don't have it in our portfolio. We are not looking at it as of now. But yes, I mean, monopolies in India, some of them, not all, some of the monopolies in India, they are benefiting massively out of arbitrages around which they've moated their franchises, and it's very difficult to break into these competitive advantages. And if that is the case, then possibly this could be a stock, but we don't have a view on it.
Rakshit, hi, good afternoon. I don't know if you guys hold telecom stocks, but just wanted your view on the Supreme Court hearing today. And it's made some scathing comments with regard to conduct of the telcos and both the DOT officials as well. I think it's clear there is no relief coming in for telcos. And since the time, I guess 3 or 4 months back when the issue started, the stock of Bharti Airtel has almost doubled. They've already made provision to pay these AGR dues, but now it looks like that the industry is headed towards where there will be just 2 players which will be left, Reliance and Bharti Airtel. What are your thoughts overall, and do you feel it makes any sort of investment sense when the industry is headed towards a place where there could be just 2 players? Because Aditya Birla Group has said they will not be infusing any more equity. Vodafone PLC CEO, they've written down the value to 0 in their books, and they've also said without any government relief, they don't expect the survival to be there.
Yeah, I mean, the kind of concentrated market shares into the hands of 2 or 3 players, that sort of a construct is actually ideal in stock picking in India, because that exists in many sectors and it rewards shareholders massively. That construct does exist here, but what doesn't exist, and we don't have any of the telecom companies in our coverage universe, what doesn't exist in India for a telecom company is the real pricing power. So let me put it this way, if you were to define pricing power as, let's say, the ability of an incumbent firm to very confidently say that even if I get competition which offers 20-30% cheaper priced product vis-a-vis my current product to the customer, right, then the customer will still keep buying my product regardless of what the price point for the same product from a competitor is, right? So for instance, if I'm an incumbent in telecom and I offer a 100 rupee monthly plan or whatever, 100 rupee 10-day plan, whatever it could be, and if a competitor comes in and offers a 70 rupee or an 80 rupee plan, will the customer leave me and go to the competitor as long as I stick to 100 rupees, or will the customer buy from me at 100? So that's in a very, very simple way the definition that we use for pricing power. In India, that doesn't exist in the telecom sector. Here, the loyalty of a customer is not really to stick to a particular provider regardless of 10-20% up or down in the price. It's instead the other way around, and hence very difficult to sort of deliver again higher degrees of returns on capital employed in telecom in India, even if you have a dominant market share. So quick quantifiable way to understand it is even before Reliance entered into this category with Jio, right? Even before Reliance entered with Jio in 2017, I think, Airtel retained its market share for the preceding 10-12 years when the industry kept compounding subscriber base addition at 35, 40, 45% annually, right? Now that's a volume growth given to a market leader whose market share is intact. 35 to 45% volume growth each year, but we didn't see the corresponding growth in earnings for Airtel over the preceding decade, because that's where the pricing power ideally should play into the hands of a market leader. It didn't. So that's one element where we see the telecom players being a little weaker than what we would like a portfolio company to be, and hence we don't have coverage in them.
Okay, no coverage there, but an important space to track. We'll wait for some commentary also from the companies itself. Let's see if they have anything to say on that. But Graphite India numbers were, I guess, flashing there on your screen. Keep an eye on that one. They posted a loss versus a profit that was seen in the corresponding quarter. Rakshit, before we thank you, the stock's actually down 5 to 5.5%. I think after HEG's numbers, it was largely expected that it will be a dampener this time around. Rakshit, what's going to be the investment theme then for the remainder of the year? We're done with December quarter earnings. I know you guys have not shied away, from paying that hefty premium for companies who have displayed good earnings performance. Is the theme going to continue?
Yes, the theme continues. Our portfolio this year, financial year 20, based on the first 9 months and expectation for the last quarter. Based on that, our portfolio is likely to deliver FY20 earnings growth of more than 30%. So more than 30%, obviously that's thanks to the corporate tax rate cut, but even at a PBT level, more than 15% growth in PBT. So 30% plus growth in PAT, in profit after tax, and a corresponding growth possibly at the blended average level for the portfolio companies in terms of share price. So we are quite comfortable with the valuations being supported by fundamentals as they both progress hand in hand for our portfolio companies. So yes, the theme will remain the same in the foreseeable future as well.
Okay. We leave it at that, Rakshit. Thanks much for taking the time out and being with us and giving us your perspective. Really appreciate your time.